And with the Fed expected to hike tomorrow, how should investors view their dividend ETFs specifically? Joining me from Princeton to discuss this further on this week's Smart Beta segment is Balchunas. He's senior ETF analyst at Bloomberg Intelligence. So when we're talking about dividend ETFs here, how do they fit into Smart Beta, right? Because we have had dividend ETFs be around for quite a while.
Yeah, so they have about $150 billion, which is that's a monster size for any category. But they're number two. Value is a little bigger at 155. Dividends were the biggest one because, look, in a low-rate environment, everybody likes dividends. But when the rates kind of went up after the election, dividend ETFs sort of stopped taking in money mostly. Haven't seen outflows, but stopped taking in money, and value started to take in money because they outperformed. But how they fit into the Smart Beta tent is interesting. So Smart Beta, considered a big circus tent. Everything's in there. But not everything's a factor. Dividends are not a factor. MSCI considers them a factor, but academics say that dividends, their returns can be explained by value, market beta, and the quality factors. So they're not really given credence in the academic world, but boy, they're popular with investors because for yield-starved investors, they are a godsend.
And as you say, one of the things that has been of concern is that they perhaps don't do as well, right, when we see rates go up. Is that sort of one of the risks here? Are there other risks also?
Yeah, look, when you're thinking about dividends, there's two main areas. It's blunt, but here's the way to look at it. There's dividend appreciation ETFs. These look for ones like VIG. The biggest one looks for companies that have increased their dividend payment for 10 years straight. So the pro here is you get a lot of high-quality names. The con, the downside, is that it only yields 2%. The 10-year Treasury yields more. Right, so if you're going there for yield, that's not going to work for you. You could do better with treasuries. The other side is high dividend paying stocks. So here, like Vanguard and iShares both have several products that just go after stocks that yield a lot. The good news here is that these are going to yield probably 2.8, 3.5%, somewhere in there. The bad news is you're going to have overweights to certain sectors. You're going to be heavy staples, utilities, and light tech. So either, they're definitely good products. The question is, what's the investor's needs? And they definitely differ. So the dividend appreciation, though, those already yield less than treasuries.
Wow. And then there are some that get more sort of specific, as ETFs always do, pretty much, beyond those big ones you were talking about. So what are some of the other choices for investors?
Yeah, TDIV, which is the First Trust Tech Dividend ETF, is interesting because, like I said, if you go for a high dividend paying ETF, you're lacking in tech. But now tech actually spits out dividends, but not all of them, only the old guard names. So TDIV, you look at the holdings, it's a very I love the 90s portfolio. You've got Cisco, Intel, IBM, Texas Instruments. But it yields 2% and it supplements your lack of tech in other areas, and it's defanged. I know FANG stocks probably freaked out investors last week, but this one would have no FANG stocks whatsoever. So investors who are looking for tech X FANG, TDIV also works for that way.
Yeah, old line tech. And just quickly here, you also have a multi-asset income ETF. What's that all about?
Yeah, if you're just looking for yield, this thing basically goes out and gets it in all places. It's 20% dividend-paying stocks, 20% MLPs, REITs, high-yield debt, yields 5.6%. It's almost like doing the job of what an advisor would do. It just goes out and gets you yield. It's definitely vulnerable to rising rates, but if you're just looking for yield, this is basically hitting the easy button.